when compliant infrastructure still carries risk. For years, infrastructure risk modeling followed a relatively simple logic. If an asset met regulatory standards, it cleared a major risk threshold. Permits secured, emissions within limits, standards satisfied, compliance signaled stability. Capital committees relied on it. Procurement teams priced contracts around it. Infrastructure investments were approved on the assumption that regulatory alignment reduced long-term volatility. That assumption is now weakening. Recent federal deregulation of vehicle GHG standards is only the latest example of how quickly regulatory baselines can shift. Whether standards tighten or loosen is less important than the pace and unpredictability of change. Infrastructure may be compliant today and misaligned tomorrow. Why compliance no longer equals low risk? The risk landscape has evolved in three structural ways. Policy cycles are shorter. Major regulatory frameworks can be reversed within a single capital planning cycle. Infrastructure assets, by contrast, are long-lived. Federal and state signals are diverging. National operators increasingly face fragmented standards rather than a uniform baseline. Compliance in one jurisdiction does not guarantee alignment elsewhere. Market expectations are decoupling from regulation. Investors, customers, and lenders may continue to evaluate transition risk independent of federal mandates. Regulatory compliance does not automatically neutralize reputational or financing exposure. Compliance remains necessary. It is no longer sufficient. Where the risk is migrating. When compliance stops acting as a hedge, risk migrates. It shifts from regulatory interpretation to capital allocation and procurement strategy. Infrastructure that is fully permitted and fully compliant may still face transition risk if policy reverses again. Stranded asset exposure if markets shift faster than regulation. Supplier contract volatility tied to emissions assumptions. Financing cost adjustments based on ESG-linked criteria. Reputational exposure if public expectations diverge from federal policy. The risk is no longer whether an asset meets today's rules. The risk is whether today's rules will matter for the full economic life of that asset. Top 5 adjustments finance and procurement leaders should make now. As organizations move toward mid-year budgeting and 2026 planning, leadership teams should recalibrate how they treat compliance within risk models. Separate regulatory compliance from market risk. Treat compliance as one variable, not a proxy for overall risk. Model scenarios where federal standards shift again, state standards diverge, investor expectations remain constant. Compliance alignment should not automatically lower the risk premium assigned to an asset. Stress test long-term infrastructure ROI under policy volatility. Rerun ROI models for fleet electrification investments, on-site generation, energy efficiency retrofits, emissions monitoring systems. Ask, does this investment remain financially resilient if policy assumptions reverse? If the answer depends entirely on regulatory direction, the asset carries elevated exposure. Reevaluate procurement contracts, built on emissions assumptions. Supplier agreements may have been priced under tightening GHG compliance trajectories, expected electrification timelines, carbon reporting requirements. If regulatory direction softens or fragments, cost structures and risk-sharing provisions may need adjustment. Procurement must now model volatility, not just compliance. Align finance and compliance functions. More directly, historically, compliance teams interpreted regulations and finance teams priced them in. That separation is increasingly inefficient. Finance leaders should require scenario modeling from compliance teams, cross-functional risk assessments before capital approval, clear documentation of which assumptions are regulatory versus market-driven. Alignment must happen before budgets are locked. Build optionality into infrastructure strategy. Infrastructure does not pivot quickly, but procurement strategy can. Consider phased deployment structures, modular investments, flexible supplier contracts, shorter pricing review windows. Optionality is now a risk management tool, the bridge to financial and procurement alignment. The larger shift underway is structural. Compliance used to simplify capital modeling. Now it introduces additional complexity. As regulatory signals fragment, financial and procurement alignment becomes the central challenge. Infrastructure decisions cannot rely on compliance alone to signal safety. They must account for capital repricing under volatility, supplier exposure under divergent standards, cost of compliance modeling that may change within budget cycles, margin impact from misaligned assumptions. This is no longer a compliance conversation, it is a financial coordination exercise. The new question. For executive teams, the question is not, are we compliant? It is, are our capital and procurement models resilient if compliance stops signaling stability? Organizations that continue to equate regulatory alignment with low risk may underprice exposure. Those that treat compliance as one input among many will be better positioned as policy cycles accelerate. Infrastructure risk has not disappeared, it has moved. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.